Many times we've talked about what is going to really move the uranium market moving forward, and we constantly point to contracting as the real push. Once we see utilities getting back into serious contracting, that's when we expect to see uranium prices really take off. So what I want to go through in this video are those 4 signs that will tell us that the utilities are getting back into the contracting game and we're getting close to seeing the market truly tighten. One of the first clues we're going to see is more public tenders for uranium contracts. The utilities will be stepping out and putting out public tenders, looking for responses on their contract needs. Now, those RFPs will not be hitting headlines. You won't necessarily see them out there, but they are showing those early signs that utilities are starting to test the waters. They want to see what those baseline numbers look like, and they're getting ready to really start contracting in earnest. The challenge becomes the only way you're going to see that happening is really starting to watch whatever public forums you can find, the World Nuclear News. You might hear Kazatomprom or Cameco announce these tenders in their quarterly statements. So for investors, this means that a quiet uptick in RFPs means that the utilities are starting to lay the groundwork for larger contracts moving forward. Everyone knows uranium's short. What matters is when it breaks. Most investors guess and miss. This report shows the signals that reveal when the turn begins. Order the report now and get ahead of the next uranium breakout. The second clue that we're looking for is less flexibility in those contract terms. For the last decade or so, we've seen that utilities really have been calling the shots because the producers needed the business. But as the market tightens, what we do see is less and less flexibility in those contracts, and the power goes to the producer, where historically we would see them having 20 to 30% flexibility in when product is delivered, in how much product is delivered. We've seen that reduce significantly over time as the producers pick up more of the power in those negotiations. Once again, the challenge is, how do you know that these terms are changing? How do you know they're tightening? Unfortunately, again, this is information that's not necessarily readily available. In order to understand how the terms are changing, how they might be tightening, one needs to look at company MD&As. You need to listen to the earning calls for Kazatomprom, for Kazakhstan, or other companies that may in fact be contracting, because they will make mention of how those terms are coming along. For example, Cameco has announced that there is far less flexibility in the current contracts that are being written. So when you hear corporations talking about tighter terms around utility contracts, they're not just putting out promotional noise. This, in fact, signals that the utilities are losing the control that they once had and that the market is truly tightening. When we see these terms starting to tighten up, what we can read from that is that the producers now have a much stronger hand. Now, of course, when contracting is truly coming back into favor, what will happen is there will be more quiet off-market deals, which becomes truly a challenge for investors to keep an eye on. About 60% of the contracts that are written are off-market, which means that we don't see the terms as they come out. They're just business agreements written between a producer and a utility that owns a reactor. And those terms aren't necessarily made public, certainly not in advance, and we will typically see them coming out over time as the product is delivered. So here, visibility truly is a problem, because you're not going to see these terms coming out in press release. You're going to have to read traders' reports. You're going to have to look to certain consulting firms which will monitor and put out what they hear and see in terms of these terms. The very fact that utilities are now locking in supply is the truest sign that we are watching the uranium market take off. For investors, this means that the more chatter that we hear, the more clues that we hear that this long-term contracting is taking place in the background, it's the clearest sign that we are into a contracting cycle. And these are not going to show up in your spot price. They're not going to show up in your long-term price. These are those quiet indicators in the background that we really have to pay attention to. The last point I want to mention that signals that we're heading into, if not into a contracting cycle, is we're going to see spot purchases now moving back towards the utilities. Now, traditionally, what we expect to see in the spot market is trading by funds and traders and more administrative moving around of inventory. What we don't see are utilities buying uranium on the spot market for their own inventory. When we do see utilities stepping back into the spot market, it is a sign that we're getting closer to contracting. This buying by utilities is really just them testing the waters and getting ready to move back into more of a contracting cycle. What's important is that spot moves that are linked to true demand and utility buying is far different than when you just see traders moving the spot market through their activity. For investors, of course, once again, this is not always an easy metric to follow. It is put out by a number of commentaries from consulting firms around the world, UXC, Trade Tech, and of course, you can pick it up every week on our podcast, Uranium Spotlight. So the takeaway for investors is when you can see and when you hear that the movement in the spot market is being driven by utilities and not traders, it's one other important clue that we are heading into or well into a contracting cycle. So the 4 signs that investors need to keep in mind if they're trying to track when we're entering into a contracting cycle is to watch for more RFPs coming out into the market. Look for less flexibility in contracting terms. We're looking for more off-market deals being transacted, and we're looking for spot market transactions shifting more towards the utilities. So for now, utilities are already laying the groundwork for their next contracting cycle, and the signs are all out there.
Everyone following uranium knows the supply shortfall is real, but what no one agrees on is when it breaks. And in this market, when is everything. Over the past decade, investors have been early, again and again. They saw the setup, but not the timing. And every year they waited, the opportunity slipped further out of reach. Today, the same signals that drove the last bull run are lining up once more. Production lags, contracting pressure, exploration collapse, but the question remains, how close are we? This report reveals the complete analytical framework behind that answer, the evidence-based model professionals are using to track the moment the turn begins. Many will be too early. Most will be too late. The ones who know when will lead the trade. Order the report now and get ahead of the next uranium breakout.